So what's working well 1 year might not work well the second year. And then maybe 4 years later, the old strategy starts working again. So you constantly have to be adapting when you're involved in the markets. But one of the biggest trends, at least from an investing standpoint, is if you go back to like the old days of Peter Lynch, where he talks about buy what you know, buy the products, companies you use. That is not a great investment philosophy right now.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. And today we're speaking with Anmol Singh about livetraders.com and what it takes to be successful when it comes to equities trading. So I know a little bit of a departure from what we normally do when it comes to investing or buying companies. However, this is a really good opportunity and good fit for some people who might be thinking about, okay, I don't really want to own another company. Maybe angel investing isn't the right fit for you. And you're looking for something different to do, or you just want to learn what it is that these hedge fund traders are doing and how they make all of their money. So it's a really good opportunity for you to learn a little bit about that. And of course, follow up with Anmol if you have any questions. Again, this is the Angels, Exits, and Acquisitions podcast. Thank you so much for being here. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. I'm joined today by Anmol Singh. Anmol, how are you?
I'm doing great. How are you?
I'm doing well. Thanks so much for being here today. We have an exciting topic to talk about with regards to trading, which is a little bit different than a lot of the conversation we've had, but there's a lot of interest around this right now. So I'm excited to hear your take on what it's all about and what it entails. But before we get into that, why don't you give people a little bit of your background?
Definitely. So I've been trading stock market for the last 15 years, started in 2010. Originally started working for prop firms. So back in the day, imagine those desks with like hundreds of traders out there. So I kind of worked my way up in the company. And then that's how I got into coaching. So once I got good at that company, then all the newer hires that would come in, so I would be responsible for training them and coaching them on the firm's methodology. So started there, 2015, the company got bought out. And that's when I went out and started my own thing, livetraders.com, where we now coach traders, train, we do seminars, and then I run a newsletter as well. So people can watch kind of what I'm doing with my own capital.
Beautiful, beautiful, wonderful. So talk to us a little bit about what that means. I've heard this term a lot, a prop firm and trading desk. What does that mean for the layperson who doesn't understand that?
Yeah, so prop firm is basically a company where, let's say there's, typically there's 2 or 3 partners. They pool up their own capital, right? So they collect, let's say, hundreds of millions of dollars. And then what they do is they divide that into different traders. So they'll bring on newer traders. It'll be a desk of like 50, 100, 200 traders. And then they would all be trading the company's money. And in exchange, the company would take a percentage of whatever you made or giving you the capital. So they typically start off people very low. And as you prove yourself, you keep getting more and more money to trade with. So it's a great way to get started in trading. Although these days, I don't really recommend people prop firms, because back in the day, prop firms, their business model was they coach you, they train you. And when you made money, they made money. Nowadays, prop firms have sort of become like glorified brokers where they don't really care if you make money or not. You just join their program and then, they collect commissions from the brokers. So they get kickbacks in that way. But back in the day, it used to be like a very, legit business to get into. So that's how I started.
And so is prop short for anything?
A proprietary trading firm. So it's called proprietary trading firm. A company would have like their own proprietary trading strategies, and that's kind of what they would train you in. Although they would also have traders who have different strategies come on, and everybody's just trading the company's money. And then the company would typically take anywhere from 10 to 30% of what you made based on what level you were at.
Okay, so it could be a very lucrative thing for these traders to want to get into it because they're using somebody else's money, but there's incentive for them to make as much as they can because the company is going to benefit. And that's why they're willing to give them the money. But you got to prove yourself. I'm assuming there's all these different strategies out there to prove yourself that you know what you're doing, right?
Yeah. So typically they give you targets. So they would give you a target. If you hit this profit target 2 weeks in a row, then we give you a little bit more money. And then you keep leveling up like that. But in the same way, when you lose money, you can also get demoted a level. Then they give you less money. So that was actually a good thing, because most people getting into the stock market these days, they don't have that structure, right? Of like, when do I scale up? When do I scale down? So it's hard to really make too many bad mistakes when you're in a firm like that, because there's accountability, right? There's a review every morning. There's a review every night. And if you are losing money, then they cut you back a little bit, or you might have a loss limit for the day. If you lose that, that's it. You're done. You can't trade anymore. Platform will lock up. You got to come back the next day, which is good because that's forced risk management. Whereas with traders who trade from home, they don't have that forced risk management. So they can keep going down the hole. There's nobody to stop them. So I think it was a really good structure that I got from there.
Yeah, that makes sense. Obviously, we're thinking about investors from an investor's point of view, not a trader's point of view, but an investor's point of view is I'm working with my advisor or a broker, and I'm going to give you, let's just say it's $100,000. And you're assuming as the investor that whoever is taking this money is going to be fiscally responsible and try and make you as much money as you can. But we all know that that's not always the way it works out. And so from a trader's perspective or a prop firm's perspective, they want to make as much money as they can too. Let's be honest with what we're doing here. But in order to do that, sometimes they're taking unnecessary risks. And what you're saying is if they take too many risks and it ends up eroding the value of that $100,000 portfolio, really the only person that's losing at this point is the investor, right? And so we want to make sure that there's some sort of mitigation factor in place where, okay, you lost a little bit this day, we're going to catch you off for the day. Reset tomorrow, come back. It's kind of like, the coach bench and their star player. Sorry, you're in a slump today. You're not hitting anything. You can't hit the broadside of a barn. We're going to put you on the bench and bring somebody else in, right? And then give them a chance at it again.
Absolutely. And if you're doing well, they keep getting you more money because you're doing well. So it's it's a great business model. But I think over time, over the years, I've seen that model gone down and where there's like funding programs and all of that. But they're not really the true measure of what prop firms used to be back in the day.
Right. And so you focus mostly on equities, it sounds like. Is that right?
Yeah, equities and options. But yeah, US equities.
Okay, US equities and options. So explain what that means to people.
Yeah, so equities, we're buying and selling stocks. So for a day trader, what a day trader would do would be looking for short-term opportunities where we'd be getting out several times a day, right? In and out. And that's what we consider the income producing style. That's kind of like a job. You have to trade every day. The goal is to make an income from it that you can live off. And then we have the other style known as swing trading, where we'll be buying a stock and we plan on holding it for a few days to a few weeks, right? So we're trading that swing. And then we have our core trading or investing, where we're holding stocks for several periods of years. So there's like 3 different buckets of trading: income producing, and then wealth building. Wealth building is where you invested for the long haul, or you're maybe buying a stock, holding it for several months. And then day trading is the income producing style, where you're trading in and out every day. And options are just derivatives. You're trying to use options if you feel good about a stock and you're looking for a bigger move. That there's a lot of benefits with options because it costs less money to buy an option than to buy a stock. So you have less capital invested. So in almost all scenarios, the ROI is going to be much higher when you're trading options. But options are something that I usually tell people, first start with stocks. Let's get good at reading the charts and get good at picking the stocks, because in the end, option is just a derivative. You're trading, an option on the stocks. You still need to know where the stock is headed. But options are a great way to do that as well.
Okay. And so when we're talking about trading equities and day trading, this sounds very, very risky to a lot of people, right? Because they've never been involved with this and they say, okay, well, I've always been told just buy and hold and wait for the long term and see what happens. So what kind of person is, really investing in this type of trading scenario?
Yeah, definitely. I think for most people, buy and hold is the right approach for most people, right? Because most people are not going to go through years of training, right? They're not going to go through years of statistical analysis where we analyze our trades and the patterns that we're trading on how they would have done over the last 20 years, or what the last 1,000 trades, what the statistics really are. So all trading really is a game of statistical probability. We're just trying to be the casino. So a casino knows that they have a certain percentage of edge. They don't care if you go and win $1 million in the casino. They're going to be like, here's some free drinks, keep playing. Here's a free stake, keep playing. Because they know the longer you play, the edge is going to take control and they're going to win a certain percentage. So trading, we're trying to do the exact same thing, right? Because think about it. If your winner is, let's say, twice the size of your average loser, you only need to be right 40% of the time. You could take 100 trades, lose on, only win 40 of them, but you're going to come out ahead if your average winner is twice the size of your loser. So we're just trying to create systems that have a statistical edge, and we're just executing on that over and over again. So that's kind of, in a nutshell, how the trading game works. But for most people, because they're not going to go through that, I always tell people trading is the closest thing to like a sport, right? Everybody wants to play basketball. Few are going to make it to the NBA. So it's not,
right.
It's a tough business to get into, but it's also the most rewarding one once you figure it out. But it takes time. Like I lost money my whole first year. Not until year 2, year 3 is when I figured it out and I got it done. So most people who come, at least my clients, they're usually people who've had successful businesses, or they've sold a business, or they've had a successful job. They're a bit later in their life, 40, 50, 60 years old. They have enough money saved up that they want to try something from home. And then those are the kind of people that we get. The ones that make great traders are honestly people who were like ex-pilots, because no matter how long the pilot has been flying a plane, he could have thousands of hours under his belt, but still every single time he's going to go through the checklist before he flies the plane. So they have really good trading habits, like going through the checklist. Does it meet our criteria? Does it meet all the statistical analysis that we have? And then they are very good at following that. And ex-poker players make for great traders too, because they know when to hold it, know when to fold it. And I think majority of the people who don't have that mindset of risk, knowing when to get out, I think that's the biggest thing they have to learn. Once they can figure that out, that there's opportunity cost. You can't just keep holding to a stock waiting for it to come back. You can always get out of one and get into another one. So I think those are the kind of traders that make for good traders. But honestly, anybody can make it as long as you have an open mind, you have the willingness to learn, and you can live through that learning curve of the first year or two. If you can hang around for that long, you'll end up figuring it out. But most people
And so it sounds like
Yeah.
it's really taking a lot of the emotion out of it, right? Like being very data driven.
Yeah, the emotions have no place in trading, because emotions will always leave you astray, right? I think a stock is going to do this. I have this thing. Nobody knows anything.
The hot tip, right?
First thing is be humble yourself and say, nobody knows anything. Market treats everybody the same way. Whether you're an ex-CEO or you're a janitor, market is what the market is. It's going to do what it's going to do. So it's the greatest meritocracy out there. But yeah, you're absolutely right. Most people come with an ego, and ego has no place in trading. You just have to realize that all we're trying to do is just execute on the statistical analysis of our back tests that we already.
Yep. Now, I'd be remiss if I didn't ask this question. I'm sure people ask me this question all the time, and I realize that there's a varying degree of answers, right? We already talked about you can lose everything, right? You don't know what you're doing, especially if you decide to go in on a hedge or a derivative, and you had no clue and you didn't have proper stop losses or any of these things we can talk about. You can lose everything. But what are some of the upsides? And obviously, there's probably some that you've seen that are like crazy awesome opportunities versus the average, right? So what are you seeing when it comes to some of the success rates of some of these people?
Yeah, success rate is quite varying. So one of the things I've noticed, at least in our community, because when we send out a survey at the end of the year, so it's like if most people stick around for like a year and a half, then the success rate is like 60%, 70% people are going to end up making it. The majority of the people who quit are going to quit in their first year, right? And that's kind of like a revolving door, at least in terms of our clients that come in. It's a revolving door. People come in, they don't make it, they realize it's harder than they thought, and then they leave. And there's like new people keep coming in. But the one thing we figured out is if they hang around at least a year and a half or two, then the success rate's like 60, 70%. And the ones that are going to quit is going to quit in the first year because they come with a lot of unrealistic expectations. They've been sold the marketing dream of trade from anywhere in the world. You're going to make millions of dollars, turn 10,000 into a million. All that's marketing gimmick. It is the hardest business you're ever going to get into. But once you figure it out, it is one of the most rewarding businesses.
Well, put some numbers around that, right? Like, so, okay, 60, 70% will make it. But what does that mean? Does that mean they're making 10% per year, 10% per month, 10% per day? Like, and are they using their own money? Are they raising money into funds? Like, how does that work out?
Yeah, so majority of the people trade their own money. We have a few people that run funds now. They're managing money after like being in the business for 4 or 5 years. But majority of our clients are retail traders. They're trading just their own capital from their own savings. And in terms of what making it means, it's different for everybody, right? If somebody's coming in with $1 million account, right, he would like to make a lot more. Whereas somebody's coming in like a retail trader with like 30,000 or 50,000, is going to be different for them. But like when I say making it, is that A, you're profitable, right? And you're able to supplement your income that you were getting from your job, from your trading. So that's what I consider making it. So when we send out the survey, we just ask them, have you been able to replace your previous job income from that? And that's kind of where the 60%, 70% numbers come from.
Gotcha. Okay. So it really does become initially a side hustle. And then, like you said, it's a financial freedom metric, right? Because it can be different for everybody. But I'd imagine most people don't go into this thinking, oh, I'm just going to replace my income. They're probably thinking, I want to create long-term wealth. I want to be able to do this in a big way and start making really serious money. Or is it? Or do they just come in and they say, hey, I just want to, replace my $60,000 to $100,000 a year job?
Yeah, there's all varies like different amounts of people that come in. As I said, some are now starting their funds. They've raised, $50 million, $100 million. They're managing the funds using,
Right.
after being in the business for a while. But majority, I would say our clients are kind of in the 100 to 200K range. That's kind of what they're making at the moment, right? And they're happy with that because they're only 2-3 years in the business or 3 years in the business. But the thing is, the compounding happens really quickly. The hardest thing is to get from zero to like 100K profit. Because once you've
Right.
got that, then your strategy's down. You've got the strategy down, the execution down. Then it's just about risking more money on those trades, right? So you can scale up to your heart's desire. There's a lot of people in our community that make 300,000, 500,000, but typically they're kind of in that bracket. And majority of them who cross that 500K level, they usually end up raising money or starting a fund or going in that direction.
Right. Okay. And obviously the market's always going up, market's always going down. It's all over the map. I was actually just doing another podcast recently. We were talking about the old school method of the modern portfolio theory. You have small cap, medium cap, and large cap. And the fact is that doesn't necessarily hold up, especially when we start talking about robo traders and AI out there and things like that. So what are some of the things that you guys are seeing in your space that maybe are either a departure from historical norms and the things are now this is the new norm, or you're saying, hey, no, this has always been the way it is. It's just that now we're able to take advantage of it because the technology's caught up and we can, it's not like the Flyboys that, I can never remember his name. Malcolm Gladwell talks about in his book, Flyboys, about the high frequency trading. Now everybody can pretty much do it, right?
Mhm.
So what are you guys seeing as far as trends and any departures from the historical norms versus where the market's heading?
Yeah, so I think, the markets obviously are always changing. They're ever dynamic. There's always changes that happen, but it's also very cyclical. So what's working well one year might not work well the second year. And then maybe 4 years later, the old strategy starts working again. So you constantly have to be adapting when you're involved in the markets. But one of the biggest trends, at least from an investing standpoint, is if you go back to like the old days of Peter Lynch, where he talks about buy what buy the products, companies you use. That is not a great investment philosophy right now. Right? If you look at Hershey stock, let's say you bought that. Or if you bought, any like companies, the products that you actually use, or you're like, hey, I have Zoom account, I have a Peloton, Peter Lynch approach of what you use. All those stocks are crushed, like down 90% since 2020. So that old thinking of buying what you know or value investing, in my opinion, is pretty outdated. It's literally the market's in a momentum. It's been in a momentum for the last, like, I would say 10 years now. So momentum is where it's at, right? What's really has the momentum, what has an uptrending pattern going on. And there's a lot of online has changed everything from Twitter, X to Reddit and all these different communities. There's companies that have a cult following that, like for example, Tesla, right? For example, Palantir, like there's cult following has become like a trend where if the community is strong, the dips end up getting bought. Whereas fundamentally, it might not make any sense at all on some of those things. So I think that it's a momentum driven market. So I think people need to learn how to read charts. They need to know what the trend is. Like, don't just hold on to a stock because you believe in it, because your belief has no place in trading if it's not statistically viable. If the stock is going down, it could be the best company on paper, but if the stock is going down, it doesn't mean anything to you, right? So it's a very momentum driven market. And I think the Mag 7 stocks, if you just bought them, would have outperformed the traditional approach of, some bond, some stock, or have some of this. You would have underperformed over the last 20 years, sticking to those value investing metrics.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Right. So I want to talk to you about something that I've heard people doing recently, and my spidey senses go up in some cases, but it really depends on your risk appetite, right? Which is, people have equity in their homes and they're taking their equity out and they're putting it into trade, which I'm assuming is what we're referring to here, right? They're finding somebody that is going to take that cash and put it into, options, day trading, equities, Forex, and things like that to generate capital to hopefully pay them more than whatever that loan is on their mortgage. And whereas I can see the appeal to that, I also harken back to the stories of the Great Depression where people were buying things on hedges and things like that. So what are some of the suggestions or things that you guys are saying or doing or working with either your clients, your students, or yourself in regards to that stuff?
Yeah, I mean, that's a great point, and it's absolutely right. I mean, in fact, I think it was a few months ago, maybe 2 months ago, Interactive Broker CEO, he came out and said the margin, like the people are using, the clients, is at an all-time high. Everybody's levered up, everybody's margined up to a T. And he said at some point, they're not able to meet the obligations or on a downturn, it's going to cause a lot of ripple effects into the markets, or because clearinghouses are going to be on the hook for a lot of that stuff, because they're the ones giving out the margin. So that's definitely a trend, credit card utilization all-time high. And the recent statistics show people are literally only making the minimum payments as well on that. And you're seeing that trend even in, companies of like Michael Saylor, MicroStrategy. That's an extremely, that actually scares me a little bit, keeps me up at night sometimes, because when that winds down in a way, or if the next downturn happens, Bitcoin goes back under, let's say 50, what happens then, right, to all those notes that he's been raising money on? So I think there's a lot of risk in the markets, but the way we teach traders is risk management is paramount. So anytime we get into a trade or investment, A, we're not putting in more than a couple percentage points on any given position, number one, right? And B, we all have exit points on everything. No matter if it's a long-term investment, no matter if it's a trade, we have investment exit points. So with that, it makes it really easy for us to size our positions accordingly. So let's say a retail trader comes in, he's like, I don't want to lose more than $10,000 on a trade. Great. Let's say you buy a stock at $90, and let's say your exit point is if it goes below 80, I'm getting out. Well, you're risking $10 per share. So if you want to lose only $10,000, then you can calculate how many shares you need to buy. So then there's no there's no thing about, okay, what if, the stock tanks or whatever? Well, if it goes 80, it's automatic exit based on our software, get you out. So then you're going to only lose the predefined amount that you were okay risking anyway. And that's how you control the risk.
Yeah, I like that. And you're right. The word was margin, not hedge. So when it comes to, and you mentioned Sailor, can you talk a little bit about what that is? Because I don't think a lot of people listening to this podcast are going to understand what you're referring to.
Yeah, I mean, I'll be the first one to say I don't fully understand the whole metrics of what he's thinking or what he's doing. But in essence, what he's really doing is he would sell his stock, right? He would do a note. He'd raise all that money. He'd use that money to buy Bitcoin. So what happens is that now he buys Bitcoin. So Bitcoin price goes up. And because when Bitcoin price goes up, MSTR, which is his stock, goes up. And as the stock goes up, he does it all over again. Raises more money, gets that out, buys Bitcoin with that money. So, and he's done that almost every other Monday. He's doing that right now. And it's great when things are going up. But it reminds me of, what was that thing happened to silver a long time ago? What was the brothers? There's the two brothers who did the same exact thing with silver. They cornered the silver market. I think maybe they got 10% of the whole silver market at one point. And then some point on a downturn, they weren't able to meet their obligations and it all got liquidated. So I think people don't learn from history, because when things are going up, everything looks pretty. But I think what happens when, all that margin comes out of the market, because there's a lot of margin in crypto markets right now.
I see. And, that's like playing with house money, right? So you think if you're playing with house money, might as well just keep doing it. But at some point, the house is going to want their money back. And if you're the one left holding the bag when the market goes down, that's definitely not the right place to be, right? So
absolutely, very, very risky.
Yeah, and I think that's makes a lot of sense what you were saying about having the fortitude to say, okay, this is what I'm willing to risk, and no more, and setting those parameters. And regardless of what you think is going to happen, like I know that a lot of people, when they're investing their own money, it is very emotional, right? Mm. And it's bound to turn around. It's bound to turn around. It's bound to turn around. Like, what was the movie about, the GameStop?
Yeah.
I can't remember the name of the movie right now, but the short squeeze that happened, and this guy, risking billions of dollars, still thinking, oh, it's going to turn around, no big deal, and put him out of business, right? So I think there's a lot of emotion that goes into investing in general. We deal with it every day here at Angel Investors Network, and people they either get caught up in the emotion of riding a wave up and hoping it's all going to work out, only to be left completely deflated if the rug gets pulled out from under them. But having those parameters in place are really, really important. So obviously you're working with a lot of folks who are, training with you, getting coached by you to learn how to do this. What would you say to an investor, somebody that has 6-7 figures in their portfolio, but doesn't want to learn this process, but they're intrigued by it? How do you suggest that they approach this model if they're interested?
There's two ways to do it, right? Like, so one of them, the easiest way is just buy the index funds, right? Don't even think about it. Like, just let your money work for you, because you're still going to get that 10 to 12% over a long enough time frame, whether the market corrects or not. Markets have always been higher where they were 10 years ago, always, every single time. So that you can live through the downturns and you don't have to do anything. Now, if you don't want to learn it, the other thing is like, for example, I run a newsletter, and that all I'm really doing is anytime I buy something or sell something, I basically let people know, right? We get on a Zoom call once a month, and then the rest of the time is just like they get all the emails and text alerts of when I'm exiting and entering. And I provide them the levels. If it goes below this level, I will be getting out. It's automatic exit, right? So there's no question about am I in it or in it. If it breaks this price, even by 1 cent, like I am out. So that helps them calculate their own risk level, but there's still some work involved. Like you still have to take your own trades. So you still have to do that. So I think there's only really two ways. Either you put in a little bit of a work and you're basically just trusting somebody and, mimicking somebody, right? Or the other thing is you just buy the index fund and you don't have to worry about it or work. Because there's only really two ways if you don't want to learn how to do it yourself. Because I don't believe in giving your money to somebody else, right? Most hedge funds at least have underperformed the market over the last 20 years every single time. You look at the top 10 hedge funds, apart from those, everybody else is getting lesser returns than the market. So then why even invest in them? Just buy the index fund yourself and get what the market's giving you. So I think those are some of the things. But similar to, like angel investing, like what you do, like you're going to have a portfolio of investments. You're not relying on one investment to make you the big bucks. One of them might, but then it's still the same approach. Some trades are not going to work. Some are going to work. With angel investing, same thing. Most of the startups, let's say, don't make it, but then the one or two that do make it is going to make up for a lot of those other ones. So I think the same approach we use in trading as well is like not all trades are going to work, right? But the ones that make the money, you try to get more on the winners than the average loser.
Yeah, absolutely. Yeah, I remember when I was writing my book, I was researching because I was a financial planner, which is essentially a glorified salesperson. And I didn't like it because I wanted to learn investment fundamentals, and I wasn't learning those. I was learning how to sell stuff, and I was learning about the rules and regulations, not how do you value and identify good opportunities. And decided I didn't want to do that. And during my research, I found out that 96%, the stat blew my mind. 96% of actively managed mutual funds did not beat the market.
Yeah.
And then you wonder, well, if that's the case, why in the world do we even have a mutual fund community? And this is about the same time that ETFs were coming out. So things have changed since then. But if the vast majority, and not just the majority, but almost all of them, can't even beat the average market, why would anybody even think that they could as an individual, especially not a sophisticated individual? But what you're saying is that there's definitely risk, but the people that are going to beat the market are going to spend a lot of time doing this.
Yeah, absolutely. Either a lot of time or you are trusting somebody else to do the work and you're relying on their analysis. So people in the newsletter, in a way, they're trusting me that I've done my job or I've done the analysis and I'm letting them know. So there's only two ways to do that. But to your point, I was going to open my hedge fund like 5 year ago, filed the paperwork. I did all that, put all the structure together. I'm going to do this. And I started, donating to a lot of charities so I can have lunch or dinner with these hedge fund guys so I can learn more about the business. And I went to all these events and literally everything was all about raising more money. How do you raise more money? All the talk. I was like, I got into it because I actually love the art of trading and investing and I want to do that. And all the talk was like, yeah, we should go to this event or this charity. Then you can meet these people. You can raise money. I got so put off. I was like, I'm not going to buy myself a job. I'm doing it from home right now. Have a nice business. Why do I want to put myself a job and tie myself with like compliance, legal? You got to do this. Now you got to make investor reports. I was like, I don't want to do any of that. And most of them underperform the hedge fund anyway because they're spending half the time going on dinners and trying to raise more money.
Yeah, that's exactly right. And I live in the world of capital raising, and it is a lot of that, right? But that is one question that does come up: is how much time does somebody have to dedicate on a daily basis to, succeed at this? Is it just an hour in the morning? Is it 8 hours a day? Is it, what's a daily schedule look like for somebody who's already been in it and is successful? Let's just put it that way.
Yeah. So if you're day trading, then obviously you need to be there, from at least 9 o'clock till like noon, right? That's kind of the main active hours. So I don't really trade after 12 o'clock. I might look at my positions that I'm already in or just see what they're doing, monitor them, or look for longer term opportunities if they come. But the day trading portion is between like 9:30 and 11:30. So if you're going to be day trading, you need to be there from 9 till 12, I would say. Right now, if you're not day trading, you're somebody who just wants to invest or do swing trading. That doesn't take that much time because the markets could be closed while you're doing your analysis, right? And then you're placing orders. These days, there's softwares out there, and most broker platforms allow you to do that. Just place all your orders the night before based on, okay, this is my target. limit order for your target. This is my stop loss. If it gets below this, I'll get out. This is my entry point. And you could do that like when the markets are closed. So swing trading and investing, I don't think that takes that much time big if being you know how to read charts, because then you know the levels, right? But if you don't know how to read charts, it could take all day because you have no strategy. You could be studying all day long and spinning your wheels. So I think that's...
What do you mean by recharge?
What do you mean?
What do you mean by recharge?
No, meaning like, for example, let's say if the markets are closed, you have placing your orders beforehand. But if you don't know how to read charts, read charts.
Read charts. Okay,
yeah.
Gotcha.
So if you don't know how to read the charts, then you don't know when to get in or out. Because you can't just randomly pick a number. If it goes below this, I'll get out. It has to be a level on a chart. So I think if you know how to read charts, honestly, 10 minutes, 5 minutes at the market close, you could do your analysis for the next day before. But if you're day trading, then obviously you have to be here, 9 o'clock till noon to be able to do those short-term opportunities.
Awesome. Wonderful. Well, Anmol, we've been going for about the half hour here, and we're getting to the end of our time. But before we go, I have one last question for you, which is knowing what you know now and thinking about all the successes and failures and things that have happened in the market over the last, however long you've been in your career. What is something you would go back and say to your younger self just before you got into this world? What piece of advice would you give your younger self?
I would just tell myself, take it slow, right? Singles and doubles. That's what builds the business, and that's how you can build a reliable business, is singles and doubles. If you're relying on a big hit, you might get lucky here and there, but eventually, at least in the stock market, the market knows how to take it back. So just singles and doubles, keep compounding that. It's a much better journey, right? And because you can achieve a lot in 5-10 years, but most people have unrealistic expectations. So I just tell myself, take it slow. I do the right thing. Don't look for the next big hit. Just singles and doubles, build your account.
I love that. Awesome. Wonderful. I really appreciate that. And I know that our listeners will as well. So how does somebody find you and learn a little bit more about you if they want to connect with you and get on your newsletter?
Yeah, definitely. So I'd like to give your listeners a free copy of my book. They can just go to go.anmol.net. They can just cover shipping wherever they are in the world. And that's a great place to start, because that at least you know how I think and what my viewpoints are. And if you agree with that, then we could always talk about working together. You can go to my website, anmol.net or livetraders.com. And there you can learn a lot more about what I do on the trading side.
Beautiful. Well, we will make sure to put all of that information into our show notes. So if you're watching this or you're listening to it anywhere you are, make sure you check out those show notes and get access to all that Anmol has available for us. So Anmol, thank you so much for being here today on the Angels, Exits, and Acquisitions podcast. It was a real pleasure getting to know you and learn a little about what you do.
Thanks for having me. It's great chatting with you.
Absolutely. Take care.